Hi, this is Kabir Mahadeva with Alpha Mortgage. I'd like to talk to you a little bit about how to decide whether or not you should pay points to get a lower rate. The big question on many people's minds today when shopping for a loan is, should I buy the rate down? Unfortunately, the rate is not the whole story. You need to know the total cost of the loan over time, the opportunity cost of paying points for this loan, the tax-adjusted cost of the money, the financial goals you want to achieve, such as creating an investment nest egg, paying off the loan sooner. On a 30-year fixed rate loan, a 1% fee usually reduces the rate by about 1/4%. On a $400,000 loan, a 1/4% difference in rate makes about a $62.35 difference in monthly payment. So at first glance, your break even on paying the point is about 64.16 months, or just a little bit over 5 years. However, this does not account for several factors. The higher the rate you pay, the more tax subsidy you get. The fact that your loan pays off more quickly at a lower rate, and the opportunity cost of using that $4,000 you paid to buy down the rate in other ways. First off, with that $4,000, you have the chance to invest it or keep it invested to earn interest and use the accumulated investment dollars to pay off the loan later. You can apply it to principal, so you borrow less. Paying it may have no benefit to you at all if you don't keep the loan for at least 5 years or more. And if you have limited funds to close, buying the rate down may not be possible. On the other hand, there are some advantages to a lower rate. First of all, with a lower rate, your payment is lower, so you may actually score a lower debt-to-income ratio to qualify for the loan. You could take the money that you save between the lower payment and the higher payment, with the tax benefits included, and pay off the loan more quickly. We call this principal adjustment. You could invest the tax-adjusted difference between the higher and lower payment and accumulate funds to pay off the loan sooner. And if your loan is assumable, it could be a benefit to your borrower if they qualify for the loan when you sell. Assumable loans typically are either FHA or VA loans. So how do you figure it all out? Well, the first thing you want to do is work with a CMPS qualified mortgage consultant who can perform a total cost analysis. This allows you to compare different options side by side, incorporate the tax benefits. For example, in a higher interest rate, you get a higher tax deduction, which slightly offsets the monthly total cost of the higher rate. You can look at different investment scenarios to see whether or not investing is better than paying off principal. And finally, it helps you understand the impact on your net worth or wealth creation over time. Most loans are kept for less than 7 years. So let's take a look at a case study for a $400,000 loan with certain assumptions: that the borrower is in a 30% tax bracket, the purchase price is about $500,000, and the home appreciates about 5% in value annually. This borrower will have 4 options today: a 4.75 interest rate with no rate-related fees, and the opportunity to invest or keep the $4,000 invested at 6% rate of return. Pay a 1% fee to get a 4.5% rate and invest the $35 tax-adjusted payment difference at 6% each month. Another option is just to have the 4.75%, again with no fee. Reduce the principal to $396, in effect using that $4,000 to reduce the principal, and then applying the $16 tax-adjusted payment difference to principal. And finally, 4.5%, 1% fee, applying the $35 tax-adjusted payment difference to principal. So now let's look at what this means from a monthly payment standpoint. If you look down to the monthly payment row, you'll see that the payments are $2,087, $2,027, $2,066, and $2,027. The tax benefits on these are laid out here, showing the effective after-tax payment. As you can see, there's a net savings of $35 per month here, $16 here, and $35 here. Cash to close is lower in this one because the $4,000 remains an investment. In these 3 options, the cash to close is the same, although in one situation that cash is applied to principal. Now let's take a look at the total cost over a 5-year period. Looking at the total cost, you can see that from a cash outlay standpoint, the 4.75% loan seems to have the most cash outlay before taxes, followed by the other three, which are all fairly close to one another, within a couple of $100s. But what's more important to look at is the after-tax cost, which shows that they're all, again, very close. Finally, looking at the net savings over a 5-year period, actually, whether you apply the funds towards principal or simply leave the funds invested, you will save a little bit more money by sticking with the higher rate and not paying points. The principal reductions in the third and fourth columns also include higher payments toward principal in those years, so the principal paid in those two columns is more than what you pay in the first two. Looking at the total 5-year total cost on a tax-adjusted basis, with the baseline all being $65,400, you can see that in fact the total tax-adjusted 5-year total cost is actually the lowest if you take the higher rate, don't pay a fee, and apply the payment differential toward principal. Now let's take a look at what happens in terms of the impact on net worth in 5 years. With this one, you have a $4,000 opening balance in an investment account with a 6% rate of return. That, in 5 years, grows to about $5,400. In the second column, you have a $35 contribution, again at a 6% rate of return, and that grows to about $2,400 in 5 years. The other two columns have no investment, but the money is applied toward principal, yielding slightly different numbers for net worth. Over 5 years, you can see that the highest impact on net worth, or the most available wealth, is created with the first option at 4.75% with no points and no fees, and keeping that $4,000 invested. The principal adjusted column is almost as good in the sense that it has a higher net worth than either of the two 4.5% options. Now let's take a look at what happens to wealth in 10 years. Here again, we have similar scenarios with net worth. The accumulated total in the first column is now a little under $7,300, in the second column a little over $5,700. The net worth is the highest for paying the point, but not by much compared to the others. As you can see, they're both very similar, but not that much different. The freedom point is defined as the time in which the amount of money you have paid towards principal plus any money you've accumulated is equal to the remaining loan balance. As you can see, all of these loans pay off in around 29 years, with the 30-year fixed rate of 4.75% paying off fairly close in terms of time frame to all of them. If you look at it from a 10-year net worth perspective, there really isn't much difference. They all come out pretty close to the same. So what do we conclude? If you're keeping the home for 5 years or less, it may not make sense to pay a 1% fee to reduce the rate by 0.25%. Over a 10-year time frame, the advantage of the lower payment accounts for a very minimal impact on net worth. Paying off principal or investing have similar results if you can get a good rate of return on the investment. And you really do need a total cost analysis to know your options. So now that you know, rather than just focusing on the rate, to really understand your options, give me a call so we can do a total cost analysis and know exactly which way to go.